Doordash just proved that you can absolutely buy growth, but man, does that receipt look messy? You're listening to Earnings Unscripted, where we unpack what actually happened in today's earnings. We are looking at Doordash, ticker DASH. It is February 18th, 2026, and this Q4 report is heavy.
Heavy is the right word. Look, headline numbers are huge. Revenue hit almost $4 billion, $39.55 to be exact. Total orders surged past 900 million. But then you look at the cash. Free cash flow collapsed. I mean, it fell 65% from last quarter down to just 254 million.
Which is wild. Hold on, just a quick disclaimer first. None of this is financial advice, just us digging through the math, right? So cash flow tanked. Net income actually dropped to 213 million. And yet?
Yeah, the stock didn't care. It was volatile, though. Right after the bell, it flushed down to the 150s, then realized, wait, the growth is real, and ripped higher during the call. Last I checked, it was trading near 198. That's a 14% gain.
That is quite the U-turn. So clearly the market is forgiving the cash burn. I assume this is all about Deliveroo. They finally closed that deal in October, right?
That is the main driver, yes. It's basically an acquisition quarter. They brought in $347 million in revenue just from Deliveroo. But digesting a company that size isn't free. You have legal fees, settlements, transaction costs. That is what ate the cash flow. It's technically a one-time pain.
One time. I feel like we hear that a lot in tech. But it's not just food delivery anymore, is it? I saw something about grocery really starting to stick.
Right. That's the other hook. Marketplace GOV, the total value of everything sold, hit almost $30 billion. And a lot of that isn't just burgers. They have over 35 million DashPass members now. The engagement is shifting. It's becoming an everything app faster than I expected.
Which explains why investors are ignoring the cash hit. They see the empire building. But Miro, buying Deliveroo is one thing. Integrating it is a nightmare. They mentioned something about unifying the tech stack. That sounds expensive.
Expensive and risky. That's actually the most important part of the letter. They are taking Doordash, Wolt, and Deliveroo and merging them onto one single code base.
Oh, wow. So they are swapping the engine while flying the plane.
Pretty much. All right, let's get into the details of how risky that actually is.
Risky seems mild. I mean, usually when companies say integration, they just mean firing half the IT department and merging email servers. This sounds harder.
Way harder. It's open heart surgery on a runner who's still sprinting. Seriously, read the shareholder letter. They aren't just patching these apps together. They are moving Doordash, Wolt, and Deliveroo onto a single global tech stack. Tony Xu didn't sugarcoat it either. He literally wrote, quote, "Sometimes that means you have to start over." That is code for this is going to be incredibly painful for my engineers.
Start over. Ugh. Investors must love reading that. Nothing says stable return like rewriting your entire product from scratch.
Right. It's bold, maybe reckless, but look at the math. You operate in over 40 countries now. You have 3 huge legacy code bases. If you keep them separate, that is entropy. It kills velocity. If, and it is a massive if, they pull this off, they get global leverage. One team in San Francisco ships a feature, and it rolls out in London and Tokyo instantly.
Okay, so it's the one app to rule them all strategy, which is great in theory, but we just saw the price tag, didn't we? That cash flow top was not subtle.
Yeah, no, it was a cliff. Free cash flow went from 723 million down to just 254. That's a 65% drop in one quarter. Poof.
Wait, hold on. That can't just be software engineers. Where did $500 million actually go?
It's the cost of digestion. It's messier than just payroll. When you close a deal this big, you get hit with huge transaction fees, legal settlements, and then there's the working capital stuff. They mentioned funds held at payment processors and bloated accounts receivable. Basically, the cash is getting stuck in the plumbing while they're renovating the house.
Stuck in the plumbing. A delicious image for a food delivery company.
You know what I mean? It's friction. And look, while the cash is stuck, their efficiency actually took a hit too. The net revenue margin, that's the take rate, dipped down to 13.3%. So they're running leaner now to try and get fat later.
And part of that getting fat later narrative is grocery. I saw that hidden in the report.
Yeah, that's the silver lining. They claimed unit economics in grocery and retail will turn positive in the second half of 2026.
Which would be huge. I mean, they've been burning money on bananas and milk for years.
Years. If that turns positive, the whole equation changes. But right now, they are bleeding cash to build a super platform. It's a classic J-curve investment. The market is betting they pull it off, but looking at that balance sheet, there is zero room for error.
So basically, we're trusting the chef before we've even tasted the meal?
Yeah. And the menu prices just went up.
Right. So where does this leave them heading into next quarter?
It leaves them, well, honestly, in a bit of a construction zone for the next few months. If you look at the Q1 guidance, they're actually projecting adjusted EBITDA to dip down. Midpoint is $725 million versus $780 this quarter.
Wait, backing up. So they just had a record quarter. The stock is popping, but profit is effectively guiding down.
Short term, yeah. Digestion takes energy. They've got Deliveroo dragging a bit on margins at first, expected to contribute less than $25 million in Q1 before it ramps up. And this is my favorite part. They explicitly blamed the weather.
The weather. Really?
Yeah. They called out a $20 million hit from severe storms Gianna and Fern.
You were kidding. They named the storms?
Printed right in the Outlook. I respect the precision. But look, investors aren't buying the stock for Q1. They're buying the back half of the year.
Because of the grocery thing.
Exactly. That's the real narrative shift. Management said unit economics in grocery and retail should turn positive in the second half of 2026.
Which is huge. We've spent years talking about how instant delivery is a cash incinerator. If they actually flip that to profitable, that's not just a food app anymore. That's, I don't know, local infrastructure?
It's the Amazon logic applied to the sidewalk. If they can unify that tech stack, getting Doordash, Wolt, and Deliveroo on one code base and stop bleeding money on retail orders, the leverage is massive.
If. That is a very expensive if.
The most expensive if in the sector right now.
So the verdict?
Watch the cash flow next time. If the tech integration works, the cash comes back. If it turns into a coding nightmare, that burn rate is going to look ugly fast. But for now, the market seems willing to give them the credit card.
Fair enough. They're building the plane, flying the plane, and apparently dodging Storm Gianna all at once. We'll be watching.
Always.
All right, let's wrap it up there before we start trying to model wind speeds ourselves. Stay tuned for a quick note on how this whole show comes together.
Yeah, let's leave it there.
If you want to keep catching these breakdowns without the headache, hit follow right now so they just show up. Just for full transparency, we use AI to help pull the filings and transcripts so we can focus on the actual story here. If there is a ticker you are dying to hear us cover, send it over to earningsunscripted@datamadness.ca. We really do read them. Thanks for listening.
See you next time.